cut to the chase. What is the character, the nature of this historic bout of euro weakness?
Well, I agree that it's largely the natural gas story. I mean, you've seen them in recent days and recent weeks move pretty much together with the euro. There is a broader global story that the market is panicking about what Fed Chair Powell will say at Jackson Hole. And so, euro has two strikes against it, and which is why it went through parity so quickly.
Steve, has the ECB got a role to play here?
Like in a Greek tragedy, there's just not that much that they can do. There's destiny that's approaching. The economy is weak. When we talk about supply chain disruptions, we're not getting our exercise bikes. When they talk about it, they're not able to heat their homes. That's really weighing on sentiment in the euro, and the ECB doesn't have a tool to address it. The UK inflation numbers last week kind of, I think led people in the market to say, why is Europe different and what can ECB do about it? And the market, then when you see the way sterling is trading and euro is trading, the market's really punishing currencies that belong to central banks that have an inflation problem, but are really ambivalent about how they're going to approach it.
Steve, how do you think they should approach it? What's the optimal way to approach the situation the UK is in at the moment, the situation the ECB is in?
It's a very tough situation. I think that when so much is supply shocks, if you're a central bank, you want to try and smooth your response. When you don't know what the duration of the supply shock is going to be, you're really working in the dark. So I think they'll probably hike less than they should. Next year, if they come out of the winter and the energy situation is more clear, they'll probably hike faster, and that could actually give the euro some legs in 2023. But this year, I think it's moving very cautiously.
Stephen, you were talking about how supply chain disruptions have caused the people in the U.S. to worry about when they get their exercise equipment, but in Europe, worried about how to heat your homes. At what point does the U.S. start to experience something more similar to the European angst? And this goes to this idea of divergence, how far the U.S. economy can diverge from the European fate.
Well, insofar as it's related to a particular commodity, as natural gas, that divergence can extend for a long time. We might have to pay more for our energy, but we're going to have it. I think the European situation, if it's a very cold winter, and if the accommodation to increase supply doesn't occur, it could happen. It could be an extended divergence. It's not our baseline, but it certainly is a risk.
If there is an extended divergence, what does that mean for how disruptive dollar strength could become if it could escalate beyond where people are currently expecting?
Well, you're seeing different currencies react differently. Like, Aussie Kiwi last week, they've done poorly like everybody else, not so terribly. They don't have that kind of exposure. You have the yen that's done reasonably well. Again, they're benefiting from oil prices going down. The natural gas situation isn't as dire for them. I think it's horses for courses. And then you have a set of currencies like, Mexico, Brazil, some of the EM currencies where interest rates are high. So there's a buffer against Fed hawkishness. So I don't think, I think if the Fed is hawkish, it's going to be a broad dollar move. We think it's going to be limited. But, I think there are different, circles of currencies that will respond differently depending on their vulnerabilities and, in some cases, their strengths.
Steve, if you had to take a bet on the next 3% on euro dollar, higher or lower, weaker, stronger, where would you place it?
I think the risk is to the downside. But if you were asking me that question in January, I'd probably say to the upside.